Hi there, I am Jackie Cummings Koski. I'm author of the book F.I.R.E for Dummies and your co-host here on Catching Up to F.I. So this is part 2 of a 2-part series about women and taxes. So if you didn't listen to last Wednesday episode, make sure you go back and listen to that and then come back and listen to this part 2. So this was a session that I did with the We Wealth Collective, and We stands for Women Empowerment. And this was a group that got together after the economy conference a few years ago and decided they wanted to keep the learning going. I absolutely love that. So they invited me to come in and talk about taxes. So we have a great discussion, tons of wonderful questions. I even had to think through many of these considerations myself when I retired back in 2019. I hold the CFP credential and I'm also a financial educator, but just remember that everything we talk about today is for information and education only. I am not a tax professional, but I think you're going to love part 2, so tune in.
Welcome to Catching Up to F.I., a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to F.I. together. So let me zero in on a few things. So I wanted to mention some things that are all stages before I kind of dive into those other sections. So at any point, these are just some tax considerations I want you to think about. So when it's a primary home, you get $250,000 per spouse of the profit for the sale of a home. Ooh. So Kim, I know you're in New York, but this is especially a big deal if you're in a high cost of living area, okay, where housing prices go up fast. So 20 years ago, if you brought a house in Manhattan or Westchester or something like that, you brought it for $100,000 way back in the day, and now it's worth $1 million. Well, when you sell it, you got a $900,000 profit, right? That's a little bit of an exaggeration, but the first $250,000 is completely tax-free. So the IRS loves homeowners. All right. I barely got a $250,000 gain, but that is per spouse. And there's some provisions around that where you have to have lived in the house, like I think 2 of the last 5 years and things like that. All these IRS rules here has a whole list of things that you have to follow. And that's when I would definitely point you to the IRS code. So brokerage accounts, we talked about this already, but the capital gains tax is much, much lower than income tax. You're either in the 0%, 15%, or 20% tax bracket. The most you pay is 20%. And I think that is on a really, really high income. And remember that when it comes to capital gains, you're only paying the tax on the growth, not what you put in, which is called, basis. That's what you put in. And then don't forget about your dividend income. So if you have a brokerage account, when dividends are paid, you're taxed that year, whether you have your dividends reinvested or not. That's just how it works. You'll get your statement from your broker the next year for the previous year.
Jackie, there's a question in the comments relating to the property, the increase in property and that $250,000. Yep. I think someone indicates that they bought their apartment as a single person 25 years ago, and then they got married. The property has increased in value. Do they get the capital gains for both them and their spouse or just themselves?
Yeah, the rule is going to be, and it's going to be also like how it's titled, like who owns the property. Assuming that both of you own it today, the rule is, and again, double check the IRS on this, but I think the rule is you have to have lived in the house 2 out of the last 5 years. So if you were both a couple that both owned it, you're a married couple, then that should count. But if you think that this applies to you, definitely check the IRS code or whatever your trusted resource is to make sure you have the details. But it's okay that you bought the house before you got married. That's fine. But you still got to look at who owns the house today. Okay.
And then a really good question, I think, says, what if the property is in your trust?
If it's in your trust, so trust has some tricky things. If it's in the name of the trust, I would have to double check this, but my inclination is that if the trust owns it, then that means you don't anymore. If it's in the name of the trust, you don't. And trusts fall under very different rules. And sometimes the IRS will specifically exclude a trust. They'll say it has to be, yeah. So, and that's why when you are setting up a trust, you do have to consider, the provisions that might things that might be negatively impacted when you're doing a trust. And normally whoever you're working with to set up the trust, they should advise you on what things make sense to go in the trust and what things don't. So yeah, that was a good question. Yeah.
And then one other question related to the property.
Okay.
Sparking a lot of discussion.
Good.
The statement that says, isn't there a millionaire's tax on property sales? If so, how does that affect the owner?
A millionaire's tax? I haven't heard that term.
And I think that's the thing with it. You hear a lot of things floating around on the internet. You hear things in conversation. It's great to have an expert on the line that can tell us, is this true or is this not?
Yeah, so I haven't heard the term millionaire's tax. So if she wants to explain what that is, I'm not aware that it's an IRS rule, but there's a lot of, just common, unprofessional type terms or layman's terms that we use, but I haven't heard that one before.
I wonder if it's the mansion tax, right? So there's a one-time tax transfer in certain states, and it's for properties that are over $1 million. But Stacey, you can add more in the comments if you know more about that.
She did. She said if your gain is over $1 million.
If your gain is over $1 million. Let me think. So I have to go back to my CFP days because, that was a doozy of an exam, and they probably asked questions like that, right?
Well, listen, this group, Jackie, will probably hit you with some questions that are
that's
great. Come back to us with those answers.
Well, and here's the thing. I learn a lot too when I do stuff like this. I haven't done a good job if there hasn't been something that I was able to learn, right? So I don't know that there's an over million. If it is, it's a very small, nuanced provision. But I'm not aware of an IRS anything in the IRS code, because I know that we had to somehow we did a really deep dive into this whole primary home IRS provision. And I guess they also try to focus on things that's going to affect a lot more people. So over the $1 million is probably going to not affect a ton of people, but I'm not sure that that's in the IRS code.
That's good to know.
But it may very well be, but from what I've seen, I don't recall. Okay, anything else before we go to the next one?
Nothing more. I think we're good to keep rolling, but keep the questions coming. This is a great discussion, ladies.
Yeah, very good. Please keep them coming. Stump Jackie, because that means I'm learning too. So I appreciate that. So with the HSA, we talked a little bit about this. I always consider that there's 4 tax benefits, not just 3. The additional one that most people don't talk about is the FICA, which is your Social Security and Medicare tax. I think it's like 7.65% if you're working for an employer. So it grows tax-free, or it's tax-free in, out, and while it grows. And you can remember that you can invest in your HSA. Just a little tip right now with the market down as big as it is, if you have an HSA laying around that's not invested or one that you forgot about, it's a good time to get that and get it invested if you want to use it for the long term. And remember, it's tax free when you do take the distributions, as long as you are using it for medical. Okay. And I guess another thing that's worth mentioning, after 65, you can take money out of your HSA. You'll still pay taxes. Well, you can take it out for anything. If it's not medical, you will pay taxes on that, but you won't pay the 20% penalty. I what I used to think that was a really cool thing to do. Oh yeah, at 65, I can take all my money out and all I got to do is pay the tax. I won't pay the penalty. And I'm thinking you could, but why would you? Because as we get older, over 65, we got a lot more health issues. So you probably won't have a problem finding medical, dental, vision, or hearing expenses that you can use your HSA dollars for tax-free. So why use it on something that is taxed? But that is the rule. After 65, no penalty. Okay, that's the HSA. And I talk a lot about HSAs. That's one of my little extra things. So anybody got any advanced courses on HSAs, I got you. Okay, small business or side hustle. Some people think small business has got to be where you have employees and all that. I've had my little teeny tiny small business since 2013. I was still working and somebody told me, or I was probably reading something where they were like, well, everybody should have a business because you can, there's a lot of expenses that become tax deductible when they otherwise are not. Okay. So even if I didn't make a profit on my business because I had enough expenses to always offset any income. Like I would do a talk or a workshop or something here and there, but I was working, so I couldn't do it a lot, but I always had enough expenses to offset it. So my profit was zero. However, I could expense things like my cell phone, my internet, my computer, back then when I printed out stuff, printing paper, mileage. So I was able to expense things that I normally would not be able to expense. So you can too. So you can deduct those expenses. That was very helpful for me. Even after I retired, I think the first 2 years after I retired, I still had zero. Now there's that misnomer out there. So let me clear that up, that if you don't make a profit for 3 years, then they're going to consider it a hobby. That is not true. Back in the day, there was something to do with racehorses, and that's how that misnomer got out there. But all you got to show is a profit motive. And that typically means you made up business cards. You got a website. You are out there, in the public, putting your business out there. The IRS isn't going to come audit you because you didn't make a profit in 3 years. Because if you think about it, most businesses, it could take way longer than that to show a profit, right? You're just getting off the ground. So at the time, I didn't know that. So I'm like worried that the IRS was going to come after me and that they were going to audit me. And I talked to, it was actually a F.I.R.E. person. I was at, I think there's a Camp Mustache here in Cincinnati that will happen at the end of the year. And he was an IRS agent. So of course I picked his brain and asked him all kinds of questions. And that was my main question. So if you have a small business, it doesn't have to be any huge business or anything like that. Or if you got a side hustle with 1099, you can very well expense a lot of deductions that you otherwise would not. So that's at every phase. Inheritance of accounts that are not retirement. We talked about the brokerage accounts, but also, if you didn't know, if you are the beneficiary of insurance, that's tax-free. So as long as it's not a retirement account, typically what you inherit is going to be completely tax-free. So with a house always also gets a step up in basis. Like if you pass away, you got profit on the house, doesn't matter. The whole house will go to, whoever the new owner is, whoever inherited it, completely tax-free. You don't have to worry about taxes there. Now, of course, if it continues to grow in value or whatever, after the person passed away, then that would count. But it's just nice to get that, step up in basis. Okay. Yeah. And here's that term again. Again, step up in basis. That's only what you are starting with. So when you pass away, if it's a brokerage account, if it's, a home or property or something like that, the person that's inheriting it, they don't pay any taxes on that. And their starting point is the value of it on the day you died. So these come into play at every phase. Okay. Any questions in the chat we need to address before I go on?
Nothing else, but if there is anything. Oh, you found something, Kim?
One with regards to the HSA, if you could step back. Someone indicated that they don't have an HSA, but their spouse does. Will he be able to use it for her expenses in the future?
Yes. And that's a very good question. So when it comes to HSAs, you've got rules that govern contributing to it. So if he's on a single high deductible health plan with an HSA, he can only contribute as a single or the single amount. Okay. However, there's another set of rules when it comes to the tax portion. And the tax portion is what governs how the funds are used. The funds can be used for any tax dependents. So regardless of whether they're on his plan or not. So if it's children, a spouse, or anybody that is a tax dependent, he can use those HSA dollars to cover expenses for any tax dependent. So you're okay with that? Yep, that's a good question though.
And along those lines, I was also happy. I got laid off in 2023 and was happy to know that I could pay premiums COBRA out of HSA. That was a qualified thing. So,
oh yes, yes.
You know, so it's a little bit only if you're unemployed and you're paying COBRA. It's not like you can pay any premiums at that point. But it's good to have some flexibility.
Yeah, that's a very good point, because generally you cannot pay for health insurance premium, but you can in your situation where it was COBRA, Medicare premiums, you can. So every single provision here, there's a long list of like details that you would want to know, or exceptions that could be helpful, like in the case of, you know, COBRA premiums.
So let me ask another question. And it may be complex. With the HSA, if your spouse has it and you do not, and you are the person that carries insurance for the family, and you lose your job and have the ability to purchase through COBRA, can you use those HSA dollars to pay those COBRA premiums? Because it's covering both.
Correct. You should, yes, you should be able to use it to cover. Yeah. Yeah.
I just learned something new.
Yeah, because at the time, again, there's almost two set of provisions and two sets of governing, I guess, bodies. So when it comes to distributions, the governing body is tax rules. So for distributions, yes, the tax rule says that you can take it out to pay whatever that plan was. And if you're covered by that plan, then absolutely. Yeah. Okay. Let's see here. So the pre-55, and like I said, we did a lot of this ahead of time, so there's not much to elaborate on here. But again, pre-55, just a reminder, I consider this the FIRE crowd. These are the areas: Roth conversions, 72T, again, which is substantially equal periodic payments. This is, you know, going to get you, allow you to avoid the 10% penalty where you set up regular payments. The ACA subsidies, we talk about that. HSA contributions and distributions are a consideration at this phase. And then, of course, if you're earning any money through whether it's a part-time job, you know, 1099, contract work, small business, all of that. And then the tax harvesting of brokerage accounts. So things I wanted to remind here. So 72T, when someone asked about that. Okay. So I figured I would get some questions about that. So like I said, I set mine up in December and I consulted 3 or 4 different calculators. They're out there to make it super easy. If you really want to dive into this, the best resource I found is 72tcalc.com. We also did like a 2-part series on the podcast, but my favorite place for a calculator is DinkyTown.net. They have every financial calculator you can think of. So I say, let's play. That's when I'm going to try to go live, and we're going to throw in some scenarios here. So if I click on that, can you tell me if you are seeing my internet browser, or are you still seeing the presentation?
Nope, it opened in a new tab. You're good to go.
Yeah. Okay. Very good. So these are my exact numbers. So when you're setting up a 72T, you don't have to use your entire IRA. The smart way is to say, how much money am I looking for annually? I was looking for about $15,000. So how big does my IRA need to be to throw off $15,000? That was what I was solving for. And this calculator does it. All right. So I put in, the only thing I put in was, let's see. So I ended up with having to do, or the math said, there's a few different calculators. So you can either choose to put in your monthly amount or choose to put in the amount that the 72T needs to be. So I just plugged in all the numbers. This 5% that you see, that's the floor now. So it makes it so easy. You don't need the blah, 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 this interest rate, that 5% is the floor. Now you can go to the IRS and you can see what the interest rates are that you're allowed to use. But I ended up using the 5%. I put in my age. I didn't really need the beneficiary age, but I used the single life expectancy. And these are things I didn't even have to think about. It put it there. So once I got that in there, it showed me, there's 3 different methods, but it showed me what I could get based on each method. So obviously this one won out, which is called the amortization. That's always the best one. But I'm going to view the report because that makes a little more sense here. So it shows the result summary. So it shows my first year of distribution, the account balance, how old I am. It fills in all this, the method that I use and all of that. So it just makes it easy. So you really don't have to tie up a lot of money to do the 72T. Don't think that you have to tie up your entire thing. So I ended up, getting about $15,000 a month. But if I change this, let's say if I had, a bigger account where I needed more money, if you can play with this and put in as many as you want. But let's say you started with a $500,000 one. Okay, so that's going to give you $30,000 a year. Eric Cooper, he's done a 72T. I think he was doing like around $15,000 a year, and he uses it as his fund bucket on top of his other income. For me, this is my basic income because I'm thinking about, HSA subsidies, or ACA subsidies and things like that. So this is a great calculator if you want to play around with it. There's a few more that are out there, but if someone's asking me, do you have a good calculator for that? I'm always going to start with DinkyTown.net because they have like every calculator you could think of. But this is, I ended up using 3 different calculators. I put together sort of like a little kit when it came to 72Ts, because if I ever got audited, I wanted to show them I used these 3 calculators. I had this is the amount of money I started with. Here's my brokerage where I set up the regular payments and all of that. So it's not that hard, especially now there's calculators that are online that make it super easy. You can, run different scenarios. And on this page, DinkyTown.net, they do a good job of like putting details about the provision and answering some questions beyond just the calculator. So they've got a lot of stuff in there that can help you count back. They go through all of that. So there's that. I'm going to attempt to flip back to let's see here. So are you seeing my slides again, 55 to 60? Okay, great. It's working. So again, we hit most of these, but just as a reminder, between 55 and 65, you're thinking about almost the same thing as the previous one, except now we're adding in the rule of 50 and 55. So I do want to dive into that a little bit more. So the rule of 55 is for separation of service from an employer. These only apply to employer-sponsored plan, not IRAs. Okay. So, and not HSAs either. So it's 55 for everyone. The IRS allows this provision, but keep in mind, just because the IRA allows the provision, it does not mean that your employer is using the provision. So you have to check with your specific employer to make sure that they have this written into what's called their summary plan description. My company offered the rule of 55, but there's other people's employers that did not. Now, if you are a public safety worker, you get a 5-year bonus and the age is 50. And they just updated this on who is considered public safety workers. That's been the big question, right? So I listed all the public safety workers. So if you're federal or state law enforcement, correction officers, customs and border protection, I think that's one of the newer ones, federal and private sector firefighters, air traffic controllers, and then emergency medical services people. I mean, typically you think that that would include people that are in ambulances, whatever, but again, everything that the IRS puts in there, sometimes it's left up to interpretation. So if you're an ER physician, are you considered a public safety worker? Maybe, I don't know, but it doesn't specifically say that it's not. And it says it's emergency medical services. So anyway, so some of these can be, these are broad, and the IRS is not going to put every single detail into the code. So if it doesn't specifically exclude it, then, it may be okay. Because if you get audited, you need to have some type of case. But this is how the separation of service rule of 55 or 50 works. Any question on this? Okay, good to go. All right, so this is pretty straightforward, and I think there's a lot of this out there. Okay, the Affordable Care Act, somebody was asking about that. So they've got this beautiful lady on the front. I'm like, I love to see the women represented. So I believe anyone headed for retirement before the age of 65, before Medicare starts, be sure to see what your options are when it comes to plans on the Healthcare.gov exchange. You can look at that without signing on. You don't need an account. And early on, when I was close to retirement, probably in my mid 40s or whatever, I was really afraid of the health insurance piece, and so many people are. And I would hear, I'd be in different FI groups, and people would say, oh, it's horrible. I'm paying $12,000 a month for it, or something crazy like that. And somebody else will say, oh, it's been good. I've been on it for 2 or 3 years or whatever. And it took me a minute to realize that a lot of what people thought had political undertones. And it's like, I wasn't trying to make a political statement. I just want like the facts. And so I had to, and this is what you will end up doing as well. I had to check for myself, and I had to do my own research to see. And it's hard to even say that it's good, whether it's good or bad, because it's very state specific. And to a point, it's county specific. So if you're in New York, I've heard that the Healthcare.gov or the exchange is not that great. They don't have a whole lot of options. They don't have a whole lot of providers. Well, Ohio, it's great because there's a lot of different providers with a lot of different plans. And I've been, when I'm going through, I'm almost seeing too many plans, but I've been very happy with it. So I'm going to just click this just to show you guys that you can check this out. So if you go to healthcare.gov/C-plans, it takes you right here. And the first thing it's going to ask you is your zip code. It's not going to give you anything unless you start there. So I'm going to put in a zip code that I know is in my county. I'm in Montgomery County, Ohio, right? So now it will allow me to do a lot of things. However, you can skip a lot of that. Okay. So if you do option 2 here, you answer questions about your current plan, your household, and things like that. This will help me get to the plan. Now, if you don't even care about that, you just want to see the full price of plans, you can do that. If you feel like you're not going to qualify for a subsidy and you just want to have a sense of how many providers are they? What do these plans look like? What are the costs if I pay rack rate? Okay. But I'm going to go here because I want to get an idea of what my subsidy might be. So I put start, don't have a plan ID, so I'm skipping that. I'm doing it just for me. Okay, so it's going to ask me a few things. So I'll go ahead and put, and I did this before, so I'm going to go ahead and put in my age, my sex. It asks you if you're pregnant or tobacco user. I'm neither one of those. I'm none of those. So I click none of those. Okay, I click continue, and it's just confirming what I just put in. I'll confirm it. And then the main thing is asking my income, my adjusted, modified adjusted gross income. Now, because everything is not taxed, when I take money out of my HSA, no tax. When I take contributions from my Roth IRA, no tax. So I've been in and some of the income that I am making, let's say from a project that I'm doing, I can offset a lot of that with my expenses. So I can easily get my, modified adjusted gross income down to about $25,000. Now that's not what I live off of, right? But I'm some of the sources that I have are not taxable and not a part of my modified adjusted gross income. So I'm using $25,000. And I go in here and it's telling me that my estimated subsidy is $822 a month. So that's pretty darn good. And this is about the maximum that you'll get. If you put a number that's too low, it's going to try to push you to Medicaid, which is a whole different system where they may, depending on the state, they may ask you to verify your income and your assets. So you don't want to get stuck in the middle of that. So I don't want my income to be too low. So $25,000 is roughly the number I need to use to get the maximum subsidy. So most of the plans that I look at, through my exchange in the county that I live in the state of Ohio, is somewhere around $700 to $800 a month, meaning that I very well could get a plan for $0. But right now I'm paying like $23. So this is a pretty good plan. It's a Cadillac plan, $500 a deductible, and then $1,500 max out of pocket. So we did that in less than 2 minutes. Right. So check it out for yourself, for your state. Just go to Healthcare.gov /C-plans, and that will allow you to put in minimal information so that you can get a sense of what type of tax credit you have, or if you don't even really care about the subsidies at this point, you can skip all of that and go straight to, let me just see the plans, let me see the providers, to get a sense of how many options I have going through Healthcare.gov. So any questions on that?
There is a question. Alicia wants to know, people who have a VA coverage, are they allowed to use the ACA because they not TRICARE or TriWest and not retired military, but VA coverage?
Yeah, it would tell you that on when you go in healthcare.gov. I don't think so. There's a question that asks, are you on Medicare, CHIP, or do you have it through an employer? CHIP is Children's Health Insurance Plan, but I've never seen it ask about VA or anything like that. So I don't think so, but it takes you through a little wizard, just like TurboTax, and it'll ask you all those questions. But I don't ever recall saying anything about the VA. So yeah. Okay, anything else on that? All right, I just wanted to show you how quick and easy that is. I'm an advocate of doing your own research and looking at things for yourself. Generally, if you're, online, on YouTube or social media, whatever, in a group, they are talking about their situation. And it's always going to be clouded by their biases or by their own situation. And so just take it with a grain of salt. Sometimes it's a great starting point to say, I'm curious about this. Let me go dig into it for myself. That's what I ended up doing a lot. Okay. So 65 to 75, we're getting to the older years. This is where you're going to think about Social Security, Medicare, and this is before your RMDs, but when you have to really start looking at your numbers and what is subject to RMDs. So as I mentioned, 85% of your Social Security benefit is tax. And for most people, they are above that $20-something thousand a year income threshold because that was not adjusted for inflation. So, all right. So I wanted to highlight the Medicare surcharge, and here's what it stands for: income related monthly adjustment amount. That is a mouthful. So I don't even like to say that. I just call it a Medicare surcharge. So just so you're not too afraid of this, I feel like there seems to always be this huge effort to avoid them. Well, you got to be making a decent amount, have a decent amount of money coming in for sure. And it's really not that much when you start to look at it. So I'm going to show you the chart here. And I have highlighted in green that very first row. So if you're single, you need to have an income of over $106,000. That's your modified adjusted gross income. So that's after deductions and all of that. For 2025, the amount for Part B, which, takes care, it's like regular health insurance, medical insurance, but it's $185. So if you're a married couple, you have to be making more than $212,000 a year in order to have that Medicare surcharge kick in. Now, if you go to this second section or the second row here, so you only start paying. So like if you are between $106,000 and $133,000, the extra amount that you pay is only $13 more a month. Nobody likes to pay that, but you are, on the higher income scale. And then this is a chart that goes through every income bracket to tell you how much more you would pay. So these aren't crazy amounts that you would pay, even if you have to pay it. Now, the Medicare surcharge, they look back 2 years. So keep that in mind. That's why looking at this roadmap is helpful, because you got to say, okay, what happened 2 years ago? What did my income look like? Now, there is an exception if you are working, because obviously if you are working, your income does not reflect you as a retired person and being on Medicare, right? So I think there's like a form you can fill out for an exception. But like if you did a Roth conversion, that's typically not a valid exception. But if you were working, 2 years ago and you're just retired, you would want to fill that form out. And there's information on that too. But I guess I just wanted to show that, what income you need to be above to even be subject to it. And if you are subject to it, how much more can you expect to pay? So these are just realistic numbers. Okay. Any questions on that?
Just a quick question, because my husband's retiring as of the end of June.
Okay.
And in considering the Medicare surcharge, I think we were told to fill out the form right away and submit it now. But I thought they look back 2 years ago and that's it. Or do we put in the exception that we're both retiring this summer?
What I have, my understanding is that you can't even file for an exception until you've actually been billed for it through the IRS or the IRS of our. Yeah, that is my understanding.
Okay.
That's probably worth a little more digging. So that means that you can't really be proactive except to know that you may expect this notice that your Medicare is going to be more, and then you respond, and they'll probably have the form number that you need to fill out for an exception, and then you send that in, and that's and that would be the most common exception. It's like, who's thinking 2 years, thinking about this surcharge, 2 years prior, right? So yeah, I do believe that you have to get billed first, and then you can do the exception. But that's worth digging in. Those are just my first impressions. Any other questions on the Medicare surcharge?
Well, let's circle back. So is there ways to pay this out of your HSA and have tax? Like, is there any other ways, benefits, right? If you are stuck with this? You
absolutely can. Well, and it's when you have the higher premium for your Medicare, that's just your Medicare premium. So since you can pay Medicare premiums with your HSA, then yes, that will cover this, because now instead of saying $185 a month or for the year, then it'll save $259 or $370. So yes, you can use it for your HSA, which is great. And the other nice thing is, when you need to provide a receipt, with your taxes, you need a receipt for anything that you're pulling out of your HSA. This is a good way, because normally it's just going to show up you'll get an annual statement of what you paid for Medicare. So all you need is that annual payment or that annual statement, and that's your receipt for the year that you covered, these HSA distributions with and you can use you can't use a credit card if you're already on Social Security, so you can't use a credit card for that. But if you are not on Social Security yet and you are on Medicare, you should be able to cover this with a credit card. So I don't know if they would charge a fee or not, but not many people do. But again, once you get on Social Security, they're going to have it deducted from your Social Security check. But you will still get an annual statement. It was a 1099-S, I think, where it's your annual Social Security statement. It'll show any taxes that were taken out. It'll show the portion that was Medicare that was taken out. And that's a very easy document to include with your taxes for that year to confirm those distributions from your HSA.
I know we're rounding up to nearing the end of our discussion, but normally at the top of the hour before we wrap, we normally pause for a group picture. And
let's do that.
Yeah, we've had a couple of folks drop off. So Sandy, we could grab a group picture with those that are left. This has been really exciting, Jackie.
So do you want me to stop share?
I don't think you have to. So
okay.
The way that this works, I'm using the group photo app within Zoom. And so what's going to happen for anybody who's new, we have some new folks.
Okay, great.
I'm going to hit the button that says take photo, and it's going to pop up on your screen, and it's going to ask for your permission. And Zoom
Gotcha.
is wonderful because as soon as you click that button, it snaps your photo. So wherever the heck you were looking, that's the photo it takes. So it's really fun for people. I wish there was a delay or something, but just know that it'll pop up. If you don't want your picture taken, say no. It'll pop up and ask you. But if you are not on camera, it will not take your photo. So if you would like to be in the group photo, this would be the time to turn on your camera. You can turn it back off when we're done. If you do not want your picture taken, then you can either turn off your camera or you can just say no, you don't agree to take the photo. So give folks a couple of seconds to pick your thing, and then
powder your nose.
Yeah, and then we'll do two so that we have two to choose from. All right, so here we go. We're clicking take photo. It's building. It's building. All right, I'm going to download this one. And now we're going to do it again. Okay. One more time. Get my apps back here. Okay, ready? Number 2.
Thank you, Sandy. And thank you for allowing us to interject, Jackie.
Yes, no problem. That's cool. I love the group, and taxes aren't the sexiest topic, although that was one of my favorite topics for CFPs because it's woven throughout every financial decision. It could be an important stuff, and I think it helps you feel more empowered that you can understand some of this stuff. A lot of it is not as complicated as many people have held it out to be, and it just is great food for thought and allows you to kind of plan better knowing some of these rules. So,
Say, taxes are probably not as sexy a topic for anyone else, but for this group,
okay, great.
They are very excited.
great.
It's something that comes up almost every month.
Yes, awesome. So hopefully I got to answer some of the questions, and we only have a couple more little things that I wanted to add. Sometimes this doesn't get talked about, but once you turn 65, your standard deduction increases. So as a single, the normal standard deduction is $15,000. You get an extra $2,000 a year to deduct as part of your standard deduction. So that takes it to $17,000. And then you can see the married couple filing joint, married couple separate, and then head of household. So you do get a little better tax break there where they're realizing, and they say the reason is to help with medical costs or whatever as you get older. So that's another message that medical costs do increase as we get older. So the IRS is helping out 65 and older there. Let's see what else you got here. So then 75 is just the last one. We did talk about most of these, but let's see, what else did I just want to show the qualified charitable distributions. So just generally, the IRS does allow, if you're at least 70 and a half, you're able to donate up to $108,000, and that's in 2025. Okay. If you are 73 right now and you are subject to required minimum distributions, they will count your QCDs toward your requirement or required distribution. And I included a link there so you can read through that if anyone's close there, or if they have someone in their life, mom, grandma, aunt, uncle, somebody, this might be helpful for them. But this is something that you can do, once you're in your older years, and somehow those RMDs are still way bigger than you anticipated. Okay. So this is, there's been some changes with the RMD ages. So I wanted to clearly show this chart. So this is required minimum distributions. Again, you can go to DinkyTown.net and you can play around with it a little bit. But if you were born after 1960, I'm assuming most people on this call probably was born after 1960, your required minimum distribution is not until age 75. So these days, mostly age 75. So I'm just going to click this, my favorite, DinkyTown.net. So if you want to play with your RMDs, you can go here. I put in 2040. That's when I turned 75. You can see here, age 75 and 2040. I faked my birth date, but I put 1965. And I put, let's say, you have $1.5 million when you retire, let's say at 65. And in 10 years, it's doubled to $3 million. Okay. And you haven't been able to do Roth conversions, and it just grew in your traditional IRA. Okay. I put my hypothetical growth rate as about 6%. Normally I use about 9%, but as you get older, that becomes more conservative with your mix. And so this will show, I'm going to view the full report, what you're going to be required to take. So you're going to be required to take almost $122,000, okay, out of your traditional IRA. Not to mention that you're going to be getting Social Security and possibly a pension or something like that. So this may be more than what you need. And this puts you, just this alone puts you in the 24% tax bracket as it stands today. So this is what people don't want. So imagine if this was $6 million. So now you got to take out $250 almost. So this is the worry that a lot of people have. And I always say, this is a rich person's problem. So if you got more in an IRA than you want, then that's great. You've got more than you need. So that's a good problem to have. But yeah, so this is another really cool calculator where you can mess around, with the numbers and things like that. So you have an idea. You might say, you know what? I don't want to be taking that much out. What if I could get mine down to $1.5 million? Now you're only having to take out 60,000. But again, that's added to what you're getting in Social Security. And this is just one person if you happen to be a married couple. So you can play
Jackie,
around
if you want to elaborate on that, there was a question about, how RMDs work, right? Husband's older than the wife, and how is RMD per person? Is he required to do it, but not me because he's 75, but I'm not?
Yeah. So there's an option in the calculator. If your sole beneficiary is a spouse, you can click that and it asks for their birth date. So you can put that in. It really doesn't change a whole. Here's where it changes is if that spouse is 10 years younger than you. That's the only thing that really makes a difference. So if your spouse is 10 years younger, then it will start to change the numbers. Let me see here if it had anything else on it. Yeah, like here it says, is sole beneficiary a spouse and more than 10 years younger than the owner? So I put no there, but if you put yes, it will show you what it would be. Let's see, Okay, so if I change this to where this person was born in 1982, we're going to see the number change. Okay, before it was 60,000. So if I change it to 1982, now the distribution's changed to 50. Yeah, and that's why it's cool to do a calculator because you instantly get your answer. And so if I go to view report, you can see that I selected yes, is the sole beneficiary a spouse and more than 10 years younger? And I put yes, that changed the number. But I think that's the only thing that really makes a significant difference. So yeah, great calculator to play around with.
If the spouse is less than 10 years younger?
It doesn't change it because if your spouse is older or less than 10 years younger, it didn't change the number. But because I was plugging in, and that's how I figured out, okay, I forgot about that 10-year rule, honestly. But, DinkyTown, they had a line for that. But yeah, you can plug in all kinds of numbers and decide, what you want to do there. Let's see what else we got here. Okay, so that covers most of the presentation. And I'm you can ask whatever questions. I can hang on for at least another 20 or so minutes if anybody wants to hang around. But I'm going to just show these slides of, and again, I'm going to share the slides, but this is just some of the guests that we've had that talked about some of the topics we covered, where we did a really deep dive. One of my favorite is the last one here, estate planning with Jenny Roselle. She is very funny. She's a young lady. I think she's in her 30s or whatever, but she's very good. She has a podcast called The Legal Tea, and she talks about cautionary tales when it comes to estate planning. She talks about celebrity, estate plans. The most recent one she did was on Gene Hackman. Again, she's only focusing on the estate planning part of it. So she's not diving into the tragic thing that happened with him and his wife. But so there's that. And for me, this is F.I.R.E for Dummies. I do cover taxes in 2 different chapters. Chapter 5, understanding how taxes work and credit scores work. But then 15, I really dive into it, asking that big question, can you really control your taxes? And after today's presentation, hopefully you can say, yes, there's a lot of things I can do. And there's a QR code if you don't already have the book or interested in getting the book. That takes you directly to Amazon. And then lastly, oh, I love this. So I put together some cool women that talk about taxes, 6 of them. I wanted to just shout out some women that, Christine Benz, everybody knows her. A lot of people may know Jean Chatsky, but there's some other women here that I think are doing a great job. So I'll put their YouTube channels there. Weth Weiser, Avante, she's a CFA and a CFP. Erin Talks Money. Oh, she is really good at explaining topics. So I've been subscribed to her channel for a long time. And then Natalie spoke at an economy 2 years ago. And her podcast is Real Estate is Taxing. So that's pretty cool. Hannah Cole on the other side with the sunlight there. She talks a lot about creatives and small business owners and taxes. But these are just some additional, I always like to highlight people that, might elaborate on some of these things or do a great job of talking about this topic. And then I'll just leave this slide up. This is how you can contact me and the podcast, Catching Up to Fi. We'd love for you to, join our Facebook group if you want this type of dialogue. We'd love for you to leave messages or, of course, to leave a review or email me. But this is how you can contact me in all kinds of ways. So, Miss Sandy, you had your hand up. What's up?
Well, I did. It was kind of an accidental thing, but I do have a question in the chat. So Jennifer is asking a great question. Is there another way to buy your book that is not through Amazon, or is that your preferred way for people to buy your product?
No, Amazon is not my preferred way. It's just the most common way. There is a website called Indie Books or Indie something where you can buy books and they come through an independent channel.
Okay.
Indie Bound. I think it's Indie Bound is the name of it. But that's, and I have been asked that question, especially this year, about, purchasing that's not on Amazon. So that slide was old.
No, I think that's great. Thank you, Jennifer. I think that's lovely too, because you're, how can we best support you? Right.
Right.
And
Thank you.
Yeah, for sure. Any other questions, ladies, or any other pieces we want to go back and revisit?
Yeah.
We've lost quite a few because it's, getting into the midday, but there's still a few here.
Oh, yeah. The ones that hang around usually get all their questions answered because it's fewer people, but I'm happy to either revisit any other area or dive into anything that didn't make sense. Let me know.
Well, I don't have a question, but I do have to say 2 things. One of the things that jumped out to me the most here that is so, I think, relevant for this group of ladies is the planning for what you know. Some of us, we just get so caught up in tax bombs and all of this and watching the market and not able to execute because we're so hesitant to make a mistake for something that's going to happen 20 years from now. But I love how you put it up there, Jackie, and showed if in fact you have to pay taxes on the back end, or if your beneficiaries inherit and have to pay taxes, it's a good problem to have.
Right. It really is. And thank you for saying that. And I just want to acknowledge that, feeling worried or concerned, whether it be the stock market, taxes, or whatever your situation is, because you've got these macro things, the stock market, we don't have any control over that. Tariffs, we don't have really any control over that. And then we've got the micro things, our situation. You got laid off of a job. Spouse or family member had a serious health issue. Those are things that really matter. So you can, focus on the things that you can possibly change or you can make an impact. But just acknowledge that, feeling anxiety, feeling worried, those are valid feelings. You shouldn't say, I shouldn't feel this way or whatever. Well, it makes people feel that way. Process it in the best way that makes sense for you. For some people, it might be a glass of Cabernet. For some people, it might be for me, it's going for a hike or a walk. For some reason, when I'm getting fresh air, especially this time of the year, I just feel better. And I focus more on maybe creative things that I'm working on, like getting ready for this presentation. This made me happy. I'm not thinking about the stock market, So acknowledge how you feel. Those feelings are valid. And start to educate yourself, and maybe learning some of these new things can, one, help you focus on something else that you do have control over. And two, the fact that you are doing something to plan, for the good, for long term, hopefully generations to come. So the things that you do with taxes or whatever, it's going to have a lasting impact. It's not just you. Normally there's other people in the chain that are coming behind you.
Thank you, Jackie, for joining us and spending some time with all of your knowledge and your experiences. Ladies, let's give Jackie a virtual or verbal round of applause.
Thank you, Jackie.
Thank you, ladies. This is awesome.
Oh, Jackie,
Thank you.
Oh, awesome. Thank you so much.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to FI. Cheers.